Tucio, the shout-out app for industries, businesses, and services.
How to start a business, funding for venture capital. While a strong idea and a well-thought-out plan are necessary for business success, having the right resources and finance is critical. This is where venture capital investment comes in, sometimes known as VC money. Startups are fledgling businesses that create a one-of-a-kind product or service to scale and disrupt existing business methods. These businesses frequently have insufficient cash or capital to operate and thrive. A venture capitalist considers the long-term return on investment based on a company's strategy and future estimates instead of a bank loan, which requires assets and financial history. A startup may receive financial, technical, or managerial assistance from a venture capital firm. They will not expect instant gains because the company is still in its early stages, but they will take an equity position. They may also be elected to the board. What exactly is venture capital? Venture finance is not new, particularly in Asia, where startup activity is rising. Adopting a venture capitalist financing strategy provides the 4 advantages listed below. Allows startups to grow and expand more quickly. The investors believe in the vision and objective of the organization. Unlike traditional banks, they are willing to take a chance, which requires confirmation of business stability. Guidance and expertise are provided. It is usual for a venture capital firm representative to be nominated to a company's board, assisting with bid decisions. Because of their particular experience, venture capital firms' representatives become valuable assets. It provides entrepreneurs with an excellent networking opportunity because venture capitalists have a more extensive network of connections across many industries. This can be advantageous for startups that wish to grow and expand quickly. Unlike bank loans, which must be returned, venture capitalists risk their own money if the business fails. They are willing to take a risk on a growing startup, where they will either reap the benefits or suffer the losses. However, consider that venture investors are incredibly picky about which firms they invest in. That is why developing an effective business plan and pitch is critical. Emphasize the uniqueness or differentiation that your company provides, as well as the predicted returns. When should you use venture capital? Founders frequently ask when it is appropriate to seek venture capital funding for their firm. To begin, ensure that you have a tried and true corporate model. This suggests that you will require a strategic plan that is previously proven to be consistent. Not only that, but you must also be able to demonstrate that the product/service meets a demand for which people are willing to pay and that you can economically market it. In your proposal, you must also explain to VCs that the monies requested will be used wisely. In other words, you must illustrate precisely what your firm will do with the funding and how the funds will help it develop. In some situations, your startup will require an influx of venture capital money. For example, you may want to prioritize team expansion. Still, you cannot persuade firm personnel to join your company since it is young, largely untested, and cannot offer a market rate salary. In some cases, venture capital may be a game changer for you. This is because fantastic applicants will be considerably more inclined to join your team if you offer more salary. Venture capitalists, VCs, invest their money in companies with substantial growth potential or have already demonstrated remarkable development. The stages of venture capital investment correspond to a company's growth steps. As a firm grows, it will almost certainly go through these stages and raise numerous rounds of venture capital funding. Some venture capital firms diversify and invest in enterprises at several stages of development, whereas others focus on a single location. Seed stage investors, for example, help early-stage enterprises launch, whereas late-stage investors help existing organizations grow. Many venture capital firms specialize in one industry or industrial vertical. VC finance is regularly used to provide significant capital to small enterprises. Furthermore, most exceptional investors provide value to the business that extends beyond money. They actively contribute to the startup's success with their skills, expertise, background, insights, and networks.
If you've enjoyed watching this video, then give this video a like and share with a friend. Also click on the subscribe button below to be notified as new videos are released.